Do you run a family trust here in Australia? Do you distribute some of that money to retired parents or adult children? Today's video is for you because the ATO have flagged some major changes to the way trust distributions are taxed here in Australia with this latest draft tax ruling. Hello everyone, my name is Rooshocks, and if you've seen any headlines recently relating to trusts, you've probably heard about this draft taxation ruling, TR 2022/D1, and it is all about trust distributions. And this is obviously going to be really key for anyone that has a family trust or is thinking about setting one up, because you need to understand this because it is going to dramatically change the way some people use their trusts. Now, a trust is an entity type here at a real basic level, will normally be used for, say, small family business, or it may hold investments. And then at the end of the year, the trust makes a profit and it distributes that profit to the beneficiaries. So this distribution to beneficiaries is what's coming under scrutiny with this draft tax ruling. And the real basics of it, it's all about making sure that the beneficiaries who are made presently entitled to the income actually benefit from that income. So it's all about trying to stop reimbursement schemes and ensuring that the money is actually flowing through to who is actually paying the tax. So trusts are typically used as a way to try and save tax by splitting up income, and this may put a halt to some of those schemes. Before I get into the next part of the video, I just want to quickly steal a minute of your time to tell you about my NFT project I've just launched called Rooshock. Rooshock is an NFT project where each token comes with real world utility. So the originals are priced at 0.088 ETH, which is around $300, and they come with 3 Australian individual tax returns. So you're getting 3 tax returns and the NFT for $300. And the cool thing is that I've already given away over $1,000 of services and goods and gift cards to some of the holders. So I'm going to continuously build at this project, reward holders in the long term. I'd love for you to go and check it out. All the links are in the description. Anyway, let's get into the next part of the video. So the way a trust basically works at the moment is, like I said, you may be running a business or hold investments. And for instance, we might have a couple who one is working, the other's not because they're running this family business. And they use a trust because it allows them to split those profits up between the two of them, even up their taxable incomes. And then in other cases, they may have children under 18 who get really small distributions. They may have children over 18 that get a distribution and use up their tax-free thresholds. They may have parents that are retired that aren't getting any kind of Centrelink benefits and therefore have no taxable income and distribute money to them. They could have siblings or other people that are defined in the trust deed that could be beneficiaries that they're splitting this income amongst. And the whole point is to take a lump sum of income and split it multiple ways and pay less tax on it than if it was just distributed to one person. And that's kind of how trusts are working at the moment. So a trust will have taxable income at the end of the year that will get split between its beneficiaries. And what that pretty much means is the beneficiaries are becoming presently entitled to that income. It therefore gets included in their tax return and they pay tax on it. So if we have $100,000, it could be split $30,000 to one beneficiary and $70,000 to the other beneficiary. And those beneficiaries will be paying tax in their personal tax returns based on those trust distributions. Now, where it becomes interesting with a trust, that may not be physically how the funds flow out of that trust. So unlike a company where a company will pay dividends and physically pay the money out to the shareholders, a trust will have maybe unpaid beneficiary accounts. So in that situation where we've distributed 30 and 70, they may have taken a 50-50 split. So they may have received 50 grand each rather than the 30 and 70. So the trust will keep track of this, but the tax will be based on that tax distribution. So we start to have these unpaid beneficiary accounts and it can get slightly messy, but people do this because they're saving on tax. The other situation may be where the trust distributes that from a tax point of view, and on their books, they make it look like that's how it was being distributed from a cash point of view as well, to clear out those unpaid beneficiary entitlements and to keep things looking nice and even on the books, while one person may be actually benefiting completely from that money and the other may not actually physically ever receive any of it, and they're just getting the tax benefits. And person A may pay the tax for person B. So it can get a little bit messy, but people are using this to just purely split profits however they want and save themselves tax. Or we may even have the situation where person A takes 30 grand out, person B takes the 70 grand out, but they've got a written agreement or maybe an unwritten agreement behind the scenes where person B is going to give that money back to person A because person A is the one who's actually earned it. Person A will pay the tax on their behalf, and really all that's happening is that person A is receiving $100,000, but they're paying tax by splitting it, so therefore they're paying less tax. So we've got all these different reimbursement agreements that are happening. So the people that are actually receiving the trust tax distribution aren't beneficially in receiving the money. And there's actually a section in the tax law called Section 100A, which is what this draft tax ruling is addressing, saying that this isn't allowed. So you can't have an agreement where you're distributing money to someone and then getting it back in cash or anything like that. That's what this is trying to put a halt to, saying that if a trust makes someone presently entitled to the income, they're distributing the income to them, they need to benefit from that income. They need to receive it and use it themselves, not just give it back to someone else. And so the reason why I talked about before about, say, adult children is what would be happening in a small family business. They may be distributing money from a tax point of view to adult children, but those adult children are never receiving the money. They're just saying, oh, that's just, part of what we would give them normally, and those kids aren't actually ever physically getting it paid into their account, or if they are, then transferring straight back to the parents' personal accounts. And this is what the ATO is saying, well then, if that happens, then we're going to say that that income distribution is null and void, and that the trustee should pay tax on that, and the trustee pays a very high amount of tax, as you can see here. Now, obviously, this is still in draft ruling stage, so there may be some minor adjustments made, but I definitely see the ATO cracking down on this. It just makes sense from their point of view to go, well, if you're going to use a trust, then you need to actually distribute the money to the people you're saying you're distributing it from a tax point of view. Otherwise, really, it's just a tax saving method with the money not following through and not flowing through to that. Now, I have had people already say, well, what about if I just give it back in cash? Well, yes, you can do that, but this is what this whole scheme is aimed at to stop. It's saying, no, that doesn't work. Now, there will be people who do that and get away with it. There'll be people that do that and get caught out with it. So this whole thing is just saying, no matter what you come up with in your head on how you're going to reimburse it or re-gift it back to people, that is what this is about stopping. Now, like I said, people will do it and they will get away with it. But under the tax law that they're proposing here, no, you cannot do that. Now, does this affect everyone? No, not all trusts are doing this. A lot of trusts are just splitting it between a husband and wife, and that's no issues. That's not what they're cracking down on, because they share finances typically. So it doesn't really matter how the cash is distributed versus trust. They're both benefiting equally from it. It is really going to be aimed at probably those ones with adult children or retired parents, I think is where they're going to aim for, where there's more likely that you're giving a tax distribution but not actually physically giving that cash distribution. And what you can do about it is obviously start by speaking to your accountant, work out, is this even really aimed at you, or what you're doing is fine? If it is something that you are doing, you need to put a plan in place of, well, are you still going to do those distributions and actually physically distribute those funds? Or are you going to change that up, maybe pay a slightly higher amount of tax, but no, you'll be covered in an audit. So definitely keep tuned for when we get the final ruling on this. Hopefully this will happen before tax time, and then people can put a bit of a plan in place on what they do in the future. If you've done stuff in the past, I wouldn't stress too much now. It'll likely apply more going forward, but it definitely is something to think about. And of course, make sure you go and check out some other videos, hit that like button, hit the subscribe button, and I'll talk to you again on the next video.